Hello, everybody. This is Daniel Young, owner and founder of Adaptive Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your financial freedom destination and maintain it so you can pass your wealth off to the next generation. This video will continue to show you what I'm offering in the Closed-End Fund Master. We take a ton of information, we consolidate that information, openly display the funds we own, show how I filter the data, and make some recommendations based on that filtered data. So the reminders, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. And I'll be going over our financial investment strategy of using closed-end funds, or CEFs, instead of investing in single entity stocks. Disclaimers, I am not a financial advisor. I am a financial strategist. The information contained in the video is provided on an as-is basis and does not represent personalized investment advice. Information is from sources believed reliable, but no guarantee or warranty is made as to its accuracy. I may be invested in some of the closed-end funds recommended or reviewed in the video, and the transparency is that we own the ones colored in blue. I assume no liability for your use of the information contained herein, and encourage you to educate yourself on the market, to consult with a licensed professional, and to know your goals before investing in anything. And though I encourage you to talk to a licensed professional to get their advice, quite honestly, because I have to say that, I also encourage you to not be afraid to walk your own path. I don't speak like the herd. I walk in limited company, and sometimes I walk alone, and I'm okay with that. And I will somewhat go over that today because there are some interesting picks in the list today. So let me share my screen. All right, so I have not moved over. Oh, let's see. Let's move this somewhat out of the way. So I have not moved over the information yet. So this is the closed-end fund master. It's got all 436, which is 2 less than last week. All 436 closed-end funds, and the yield across all funds is still about 8.68. Had a fund in the M's section. I forget which font, but had a fund disappear in this section, and one of my favorite funds delisted. They decided to liquidate the account and return money to the shareholders. So the fund delisted, and now I'm waiting for that money back. So 2 funds less. There's still a lot to choose from. So it's a lot of data. If you read the information at the top, you'll somewhat see how we sort the data. Every company owned in blue we own. Purple is recommended. Black does not meet, or dark gray does not meet the parameters. Olive is just stuff we track, and everything white just doesn't fit into any of those parameters. So in order to best sort this, I like to sort by discount, and I like to sort by target. And then to further differentiate, copy the list to see my other current windows open, and transpose the data. This current box, I like to fill in when I buy stocks. I like to know what I already have. Insert to the right. So first things first, we don't buy premium. Closed-end funds are different in that they have a closed or set number of shares where they really do fall into supply and demand. When the supply is hot and people want, when the supply is short and people are seeking out these funds, the number of available shares drop, price goes up. When For whatever reason, people sell shares, and closed-end funds seem to get hit harder than other corners of the market just because the closed-end fund corner of the market is smaller than the market at large. So for whatever reason, people tend to sell their shares within this section first. So when shares go up, or when overall available share numbers increase, then the price goes down. General supply and demand. So first and foremost, we don't pay premium. So we can delete these rows. Next, I need to group these based on target. And I've started making easier data points, even more than filling this out. So everything in light blue we own. We have no plans to add anything else. That being said, I'm going to leave some funds in this final triple asterisk section for right now. So everything in single asterisk is, well, I'll show you. Spreadsheet wise, we're just tracking. So it does not have a buy alert or a triple asterisk. It does not have a dollar cost average alert or a double asterisk. It's just tracking for one reason or another. So as much as I love these funds, or most of these funds, some of these I've marked for sale at 20%, which you can see based on this tab. So every fund, so the overall fund name, the ticker symbol, when or say how long we're holding it, when it pays, when we've bought it, current average share price. So the share price of everything we've bought, but the overall average share price, our total investments, scroll across, current dividend per period, and how each buying amount is doing on dividend, the overall net NAV or the net asset value and the discount, current accumulated dividends, the return of investment based on the dividend, current share price, current value, the overall return of investment, which does not calculate in the dividend. This total return of investment is the return of investment and the dividend together. So done all the way through. And if I ever gave access to this, you would be able to see all the formulas. So the master, I want to reorganize. And we come over to today's video. So as much as I love some of these, they don't fit the parameters. Now, the parameters and the targets and why these little black arrows or little black tabs matter. So if we look at all the data, it's still confusing, right? Like it's a list of 28 funds. Okay, well, how do you pick what's best? And we could look at overall price and just buy cheaper. We could buy based on the overall dividend and pick the best dividend. We could buy based on the annual dividend, which reorders a little as well. We could buy based on the overall yield. And there are funds that pay amazing dividends right now. The best way is to look at the discount because it'll show you the best, it'll show you the deal you're getting and show you the best deal you're getting in comparison to other funds. So if we rank these by discount, what I've started doing on targets and identifying these targets, so then rank these in reverse. So these are ranked largest to smallest discount and then by target category. So if we look at the notes on DNIF, DNIF's a nice fund. It's structured well, seems to do well. Historically, the discount is a negative 13 or 13% discount. And then at 5 years, it's 26. And currently, it's greater than all of that. So just based on discount, it's a as Brett Owens would say, it's a fat score. So just under that is a fund we own. Same idea. So historical discount near 15%, currently double of that. 5-year discount at 19% and almost double of that. And it's got a buyback in place. So if we take the discount and use that as our number one metric to sort, then these targets down here, even though they are great dollar cost averages, meaning they're all priced lower than our existing average for the fund. HQL is at 13, and I know that because I have a reference of what everything is for us. That's our current existing average price. The AGD might be the one, maybe the one difference. Let's see. Yep, it's the one above. So I can actually take it off this list by doing, well, one, it would be two things. It would go to a single asterisk, but then it also doesn't need to be here. So if we go just based on discount, uh, let's see, HQL, 12% buyback through this month, actually next week. The historical and 5-year discounts are pretty close, both around 8%, but that's still less. We'll say double that discount is still more than the existing discount. GLO, similar bounce pattern to ZTR. 2-year bounce pattern, meaning like it just goes up and down. Historically priced near 10% discount, 5 years about 8% discount, and that doesn't meet the qualifications. So if we take these out, and we're screening solely based on discount right now, then we're left with 20 funds, which is a lot easier than 30, a lot easier than 40, 50, etc. But that's still a lot of targets. Well, since we have a shorter list and they're all targets based on this buy alert, and that their discounts are either, scroll back over here. So the buy alert's either double the historical discount or the 5-year average, or they're finally below premium. USA is not currently on this list, and that's really what that notation is related to. USA hardly hits discounted territory, so even though the discount might only be a 0.5% discount, it has a buy alert because it doesn't stay in discount territory. Territory long. So if we use the historic or the 5-year average, these are double of that at least, either one or the other, or sometimes both. KYN, historically, there is no discount. It's just premium. The 5-year average discount is 11% off, almost 12% off, which 15 is not double 11, or almost 12, but it's huge compared to the historical discount because there is no discount. So if we can narrow down our list just based on the discount and its overall relation historically or 5 years, then I like to sort by the actual yield. And I always like yield at the top. That's just me. So my goal has been to push our yield. I like yields that are sustainable, but my goal has been to really push and push and push for something 9 or above. Now, I didn't screen this before I did this in this regard. So this works to our advantage. FEI does not meet that 9% above. And for us, we have no plans to add anything that we don't currently own. Like I don't plan to buy any other stock that we don't currently own. If we did, let's see, ASG is the sister company of USA. That's kind of been on my hit list a while. I like, so If you see the notes so far, it's a safe municipal bond by somebody I read. I've always liked municipal bonds that invest in the state that I live in. DNIF and CHW both, even IDE. And for me, I like balanced dividends in ways in that we have lots of funds that pay monthly. Like that's good, and we'll continue to buy monthly. KYN and KMF are sister funds. KMF supposedly is getting bought out by KYN, but that deal has not processed yet. Last year they paid on this schedule. This year they are actually paying on a real category one, so a 14710 distribution. So if that keeps up, I'll have to update and edit this list next year. Of when they're actually, so the schedule of when they're projected to pay, and then when they actually pay will get updated as we go. But I don't like to have too many per category outside of monthly. Currently, we have 3 category 3s with the goal to sell one soon. That would leave us with 2. This fund delisted. That would leave us with 0. Of the other existing category 2s, you'll note that none of them are in this list. And in general, FGB is kind of that way. FGB is kind of that way. It pays on this slightly alternate schedule. But we don't have a real category 2. I'd be okay with picking up another category 1. Category 1 just meaning category 2, category 3 just meaning the month they actually pay the dividend. So 14710, 25811, 36912. USA pays on an alternate schedule. KYN and KMF did last year. FGB pays on an alternate schedule. Then the rest are actually based on month of payment. So could we add another one here if we sold Cuba? Yes. Could we add another one here at some point? Yes. It just hasn't been my focus right now. If I'm sticking to the overall discount in relation to its historical data, and then I'm screening based on yield, then, and I'm not buying anything new, then all of this stuff goes away. And you can argue that if I'm going for 9, those 3 would stay. And based on reading and market knowledge and how things have been trending, for me, I would further sort this down. So if I'm looking for a specific fund of something I don't already have, I would look here, but I'm not. Maybe you are, but I'm not. Let's see. So oil and energy transfer. So oil, natural gas, and then overall just energy transfer. Private equity and business development. Data management, cloud services, other holdings. Banking and convertible bonds. Technology, and kind of the infrastructure of technology. And then it's ZTR is really a portfolio in a can. It's everything. And having, say, I got a semi-annual report from them, I think last month, and they own a little bit of everything here and there. It's crazy. I've done a meme review using ZTR as the comparison, and it's crazy how much is inside that portfolio. But of where I would go, it's very much similar to last week. Private equity is tempting. These two I'm mixed on. I like this company more than this one, but just as a shareholder perspective, I don't like how HFRO does their PR with their shareholders, including me. Um, but if we go based on discount, so HFRO solely based on discount has the best deal, has the cheapest deal in that regard. You're paying like 65 cents for every dollar invested. Um, HGLB is close. Me, I would go oil because I think that's going to be huge. I don't know why it's every time. It's the same spreadsheet, right? Like no numbers over there. For whatever reason, it converts this column into a percentage every time. Um, GLO did not make the cut, but GLO and ZTR are on a similar bounce. I would almost buy the two together, even though it's not in this three asterisk bunch. We'll go find it over here. Here. Um, it's close to that 5-year discount. Uh, it's up from the 10-year historical discount, but on that bounce pattern and of where we are and what looks like to be the curve, we can pull it up here. Yep. All of these little swings and divots, swings up, down, and there's about a 2-year gap between each transition. So we hit the peak, right? Now a year, starting to be almost 2 years later, we're at the bottom. If we're trending up and it repeats the same pattern, then it will swing up. And for us, it's a great dollar cost average pickup. And it's the same idea. It's a portfolio in a can. You just wouldn't know it based on the holdings listed here. But since they sent me a semi-annual report and I get to see everything that they, or I guess I currently own through them, it really is a portfolio in a can. And it's posed to do well. So that being said, it didn't actually make the list this week. But if I'm buying ZTR, and I would not have a whole portfolio of that bounce pattern or that swing pattern. Um, I mean, the moonshots are great if you sell, if you buy low and sell high. If you're just kind of riding the wave, then you want to buy low and ride the wave high and low again, buy low, ride the wave high and low again, and you collect this amazing dividend the whole time. Uh, but for me, so if I'm buying ZTR, then I would buy GLO with it because I want to buy both moonshots at the same time. That's just me. Um, I mean, they're back to back in our portfolio, and I would push both to 200 and then move on to something else. Moonshots are great. A portfolio full of moonshots, not great. Um, Portfolio weighted heavy on moonshots, not great. Uh, Outside of those, if I'm looking for that third option, AI has been huge, but I think we're seeing somewhat of an AI bubble. I mean, everybody's coming off of Chat GPT and all this other stuff. And we're going to have to hit a peak and have a little reset after. Um, these are great dollar cost. Almost everything on this list is a great, I actually want to say everything on this list is still a good dollar cost average for us. But for outside of just picking up an amazing deal with this, I mean, my goal is probably to sell HFRO and I would keep HGLB. Not because of yield or price or discount or anything. It's just that I'm not sold on the investor side of things. I'm not sold on how they're on how they're running the company on appearance sake. On the background data, they come well recommended on how the company's run, but based on what they're actually telling me, I don't like how they're run. Um, so as a number three option, I would go private equity, business development. And from this list, cloud and data management, um, technology still. I would leave it at that. I love HTY. It's a great dollar cost average. It's a great dollar cost average. And the fund has done well. I like these banking groups. I do enjoy this company. I mean, outside of HFRO, I like this listing. It's just trying to sort it down into what you can afford to buy. So I'm putting numbers of what I would buy or where I would put our money. At the same time, it's going to come down to how much money you have and where you can put it. If you want a great all-around portfolio that has a little bit of everything, if you want, and if you look at how most people advise you diversify, invest in single companies across different sectors of the market. And what closed-end funds do is you're still invested into different sectors of the market, except you're invested through this one fund who then owns all of this other stuff. So if you want to invest in oil, natural gas, energy transfer, KYN's portfolio is diversified through that piece of the pie. HFRO is data management, cloud networking. HGLB is two. That's private equity and business development, more banking heavy, still technology heavy. ZTR is not just one corner of the market. It is on that whole circle of things. Like their portfolio is weighted in different margins as you go around that whole piece of the pie. GLO is too. So every one of these funds is diversifying for you in their area of focus, except some of these are actually invested in everything in every sector of the market. So if I had to pick an outright fourth that wasn't combining ZTR and GLO together, I would probably dollar cost average HTY or pick up HFRO at a much lower price, just so I could dollar cost average it and get a better sale price. It is up here. So our current price at 971 is almost $1 more than what it is now. I could pick up 50 shares and then lower our overall average price so that when I sell it, I get a better sale price. And that's kind of the interesting thing about this. So regardless of when you sell, the value of your portfolio matters, right? Because at some point you will sell, or maybe you don't. You leave it to your kids and let them sell it. But the value only matters when you sell it. So the value in between, right? You could gain a little here or a little there, but the dividend is what we're focusing on. We're using the discount as our number one way to clear out and focus our investments. Because everything's a great buy just based on the overall market. Technology has raised the market overall. Every other sector has not been like technology. So you can score a good deal. But, well, even that, so fine, you score a good deal and it pays a great dividend. But did you really get a great deal based on the overall discount? You'll get a discount with closed-end funds. You do not get discounts with single stock. So if we use the discount as our indicator on what to buy, that really narrows our list. So if you had enough money to invest in all of these, could you? Yes. Should you? I leave that up to you. if we had enough money to buy 50 shares of all of this stuff, which what I love about, oops, Google Sheets, just to say, so if we had this much, and I wanted to know how much that is, it's down here at the corner. So if we had $2,300 and could pick up 50 shares of all of this stuff, would I? I still don't know. I don't know if I would pick up technology right now, just based on the overall market. Oil will do well long term regardless. Oil is here to stay, and it's involved in so much more than you really realize. Laminate flooring, the computer I'm using right now, your phone, computer, tablet, laptop, whatever you're using to watch videos on YouTube, that's a byproduct of the oil market. Computer mouse, the sealant on this table, the shelves behind me are sealed. The sealant on those shelves are a byproduct of the oil industry. The metal pipes, the coating on those are a byproduct of the oil industry. Um, let's see, our shredder oil, right, is a byproduct of the oil industry. Uh, Vinyl floors, uh, your roof, different types of really the paint. I mean, like everything around components in walkers and crutches and medical devices, and there's so much that hinges on a great oil or on our oil economy and our energy transfer economy that when the oil market suffers, everything else goes up because that's supply and demand. We cut supply, right? All of this other stuff still needs to be done. So it's needed. So it's needed. There's low supply. Everything costs more. When we resupply, we unleash our production again, then the cost of all this stuff goes down. And then that also bears on the overall economy. So whether you like it or not, oil is here to stay. Uh, Data will come and go based on the market overall. Do we need it? Yes, because I mean, let's be honest. I'm making a video on a computer. You're watching a video on another device. That's all data and cloud management. That's all AI. It's here to stay, but we're still trying to figure out the rules and parameters of a lot of that stuff. Um, the chips, the chips for all AI is an oil byproduct. The laptop, the technology, all that stuff is an oil byproduct. So when you're buying AI, you're inadvertently investing in oil, which is why that oil and energy transfer company just stays at the top of our list right now. ZTR and GLO are a complete portfolio in a can. FGB, business development, private equity, yes. After that, I would just call it that. I would say those four, and then maybe not use that full 2,300. Maybe I would optimize what I had in, if I go backwards, say ZTR is 50. I could do the same math. That's 880. I could buy 100 shares of GLO and maybe save the rest and see how it goes next month. If I had 2,300 a month to invest or $3,000 a month to invest, that's a different ballgame. If you've got enough to slap down 50 shares, and I like 50, or I like sets of 50 because it's just easier math. But if you have, say, if you had 50 total and you wanted whole shares, then you can snag a 10 pack per se of these funds easy. It just kind of depends on your goals. But these are my picks for the week. I mean, we can play what if all day. We can play what if all day, but I don't exactly enjoy playing what if. Um, what if gets murky. So those are the top selections for the week. If you like the content, consider subscribing to my channel, and then also check out my financial meme playlist, where I use this same strategy, the overall closed-end fund strategy, to look at all those financial memes that advise you to invest your money into individual stocks, and then also just do some rational thinking as we process what's in those memes. You can also head over to Facebook and join my group there called Navigate Your Finances. I talk about earned income and passive income on Facebook. And then I talk about portfolio income and just general financial strategy through uh, sifting out those financial memes on YouTube. So as you face the week, as you look ahead in your journey, wherever you are, right, and wherever you're headed, just remember you're the captain of your ship. You have the power to change your life and your financial future. Many people will offer to help you, but only you can make the choice to do it. Make it happen. Shock your world. It is far easier than what you think on far easier than what society tells you to change your financial life, change your financial future, and make some progress toward those dreams that you want to accomplish. So whatever you're up to this week, I hope you have a great week. And I will, yeah, sorry, email after email, text after text. Um, sorry. So whatever you've got this week, I hope it goes well. If you have no idea what you're doing financially, come find me on Facebook. Check out the page, look at the files, and if you need questions, by all means, ask. So hope you have a great week. I will see y'all on another video. Bye-bye.